If emerging markets stood as major beneficiaries of the global rebalancing that resulted from 6 years of ultra-loose monetary policy, then events of the past few months have raised questions around whether this time really was any different. In 2010, capital inflows had already found their pre-crisis peaks. By 2013, inflows touched new records, reflecting investor infatuation with all things EM. Emerging markets had decoupled, we were told. This time would be different. But with the US now powering global recovery efforts, the Fed is attempting to normalize interest rates and wind down a $4.5 trillion balance sheet. In anticipation of liftoff, EM equity markets have erased nearly 6 years of gains. Bond spreads are signaling rising credit anxieties, and currencies have retraced their exaggerated steps. Meanwhile, political tensions in countries from Turkey to Malaysia, concerns about the state of China's economy, ongoing deterioration in Russia, and a focus on corruption in markets like Brazil are testing investor appetite. The sharp reversal in capital flows has punished the prospects of many emerging markets that had, up to now, relied on credit-led growth. Add the negative wealth effects of lower commodity prices and the currency-induced erosion in purchasing power, and emerging markets are now at the center of global growth fears. We expect emerging market growth to dip below the 4% mark for the first time this year since 2009. In fact, over the first half of the year, the decoupled darlings were actually a drag on global trade growth. So volatility is here, and perceptions of emerging markets have clearly turned. But therein lays the upside. Capital outflows from emerging markets have been pegged by some at close to double the amount of the financial crisis years. While the actual data suggests a less hysterical reality, such hyperbole illustrates the extent to which the entire asset class has been tarred with the same brush. Have markets overshot in their rush to the exit? There is no doubt that, in general, countries which rely on foreign capital to finance current account deficits are expected to come under pressure. But there are divergences. Many countries have taken advantage of the last few years to boost competitiveness, implement labor market adjustments, improve the efficiency of public institutions, and bolster sovereign wealth funds. In addition, while hot money swings and ensuing currency impact will make debt repayments more difficult for some, this is not the emerging market debt crisis of the late 90s. Notwithstanding the considerable variation between markets, emerging market net external debt has declined significantly as a share of GDP. Sovereign debt is now much smaller relative to foreign currency reserves than in previous periods of stress, with the private sector assuming increased foreign currency vulnerabilities. To help distinguish the relative winners from the losers, we looked at trends around private credit growth, current account balances, portfolio flows, and commercial environments. The bottom of the list was populated by countries like Argentina, Venezuela, Turkey, Ukraine. The relatively less exposed countries, however, included Poland, Philippines, Chile, and even OPEC members Qatar, the UAE, and Saudi Arabia. By taking the shine off the entire asset class, ongoing capital flight from emerging markets has paved the way for companies looking to grow their market share in previously hyper-competitive regions. As the US economy continues to pick up steam, recovery can come fast to the rest of the world, and to emerging markets in particular. There will be more casualties, but the upside here can be dramatic. We still expect emerging markets to grow at almost double the pace of developed countries over the next 2 years. The bottom line? There is an upside to the capital punishment that is currently hammering emerging markets. Market overreaction is creating opportunity for exporters and investors that are well informed and that can separate the fundamentals from the fiction. Higher US rates cannot be isolated as a risk factor, but should be seen in the context of a stronger US economy and the impact that will have on the rest of the world. Until next time, I'm Stuart Bergman.